we've been in range the last few weeks, and there hasn't been much movement in and out of it. It's been sort of these fake outs and shakeouts. And the move, it was starting to look like we could have potentially set up for a head and shoulders in the S&P, particularly in SPY, but something a little bit uncharacteristic of a head and shoulders happened. The right shoulder, which is the hump, I'm going to show this better in the weekend review video, but it's important for our purposes now, did eclipse the left shoulder. And usually if you're going to see a head and shoulders setup, they have to be equal, or really for the follow-through, you really want to see the right shoulder be lower than the left. And in this instance, the right shoulder is higher than the left. So to me, that sort of negates that pattern a bit. Today's S&P move held the 100-day moving average. We did, at least on a closing basis, in both the SPY and the cash. It had been a little bit precarious earlier. We touched down to it, to the tick, basically, in the cash. SPY was a little bit below it for a while, but SPY had a dividend the other day, so I believe that that's been what's weighing a little more on SPY over the cash. The good news for the bulls is that we've held above the breakout zone that I saw as key, is the 208.97. That is short term here going to be a pretty important level. If we get below there, I think that the sort of double bottom lows are going to come into play in the 207, the 207.69-ish, 207.79-ish, within that 10 cents. And if that low gives, I think that there's going to be a fairly decent, quote-unquote, air pocket down to like the 206s and potentially the 205s. And in that area, then I would say it's sort of a bit of a wait and see and reevaluate. I've said for a long time, I think that really the big downside risk here is to the 61.8 fib, which is 203.94, with a potential overshoot to 201.90. So that would be your correction, so to speak. You know, everyone wants to talk about the big bad old correction. Let's just get it out on the table. That's what it would look like. So let's also discuss IWM. That has been stronger, relatively stronger. The big breakout zone, and I had discussed these levels on the stream, was the 127.13. We looked below there, but we closed above. The close in IWM was a little bit softer than the one I believe that we saw in SPY. SPY actually did close positive, but I'd be willing to say that IWM is still quote-unquote healthy as long as it doesn't really get much below the, what do we got here, 124.48-ish to, like, let's just say like close to 125, mid 124s. If we can hold that, I would say that the upper distribution is soundly held, and that the IWM could still see higher. Anything below there to me starts getting a little bit iffy, and we have to start talking about 50-day moving averages and the 100-day. In general, IWM is stronger. There was a rebalancing today, so I put a little less weight on the price action today in IWM. So that is my my opinion. The Dow held up. If you were wondering why the Dow held up, it was because of Nike. Nike had a big beat. They were up, and that's really what sort of held things in there. I think actually these indexes did a very good job in hiding and masking a lot of weakness in the momentum stocks. And some of the ones that we talk about regularly, like an Apple, Amazon was down a bit. Alibaba has been sort of a train wreck. These stocks, I mean, the list goes on, the litany. The one that was really the relative outperformer is Facebook, and we're going to discuss that a little bit later. But this definitely took out a lot of the wind from the sails of the bulls, and I think it was because of a couple of dynamics that come into play at the end of a quarter. There's always the well-known one of window dressing, but there's a less known one known as the lock-in, and that's after you've had a really big run. And if you look at some of the names that have been pulling back over the last few days, like sort of the harder pullbacks, those are the ones that really ran ahead. And I think it's that funds are locking in their profits because they're afraid of Greek headline tape bombs. And that sort of explains your weakness in cybersecurity, like FireEyes and CyberArks. They also ran a lot. I mean, those stocks were up so big, they had no pullback. This is sort of the pullback. I'm looking actually as them as a buy the dip situation. I believe that they are sound stories with years of growth ahead of them. The check back to the breakout for FireEye was about 46.5. That's the 50% Fibonacci retracement. So somewhere in those mid 40s, I think, should catch it, depending on how the tape is. And I'd be looking to be either a buyer of shares or more likely a buyer of seller of out of the money puts to sort of extend my ability to be long the stock and sort of lower my cost basis. So IV will get jacked up as the stock comes down. I would sell those lower than normal out of the money puts. Something maybe in the high 30s or low 40s would be good. And I'll do that when it sort of touches down back into that breakout retest. So that covers, I think, the cybersecurity stocks. Let's just go down the checklist here. Someone had asked me about energy. So when I think of energy, I think of crude oil. It's been roughly hovering around the 50-day moving average here. I've said on the stream that I think that oil is going to see 67.34, which is the 38.2% check back. And I also am anticipating actually a run back to the 50% fib, which is $75. You would not know it by the way these oil stocks behave. ExxonMobil has behaved sort of atrociously. I thought it was sort of looking like it had wanted to perk back up a bit. If you look at the chart pattern, it's sort of looking a little bit like an inverse head and shoulders, although the right shoulder in this instance is slightly below where the left was. So I think if you want to play row on Exxon against, like, let's say 33 with some give maybe down to the old low of 82.68, I think that's sort of okay. Chevron has also looked kind of crappy. Sorry, pardon my use of four-letter diction, but I think that does a pretty good job of describing them. But these stocks have had multi-day move downs, and their dividend yield is starting to get attractive as it gets close to sort of to that asymptotic relationship with 4%. I believe that's sort of the floor, or I should say the ceiling, as far as these yields are going to go. I don't think that they would get much above there. So yeah, there's a little bit more room down in some of these, but I think that the yields are going to start catching them. Speaking of yield, every talking head, all of the intelligentsia is talking about interest rates and what the Fed is going to do and what the Fed might not do. They have been saying for a while that they are data dependent, and the data that has been coming in, although ex-consumer confidence, that number was fairly strong today. But I think really what the key is going to be is the Atlanta Fed. They give the forecast, really the growth forecast, so we'll have to see how that works out. If you take a look at the TLT, that has not been behaving well. I really was thinking that I've been under the thesis, and I still am, that this idea of the lower for longer hashtag, I believe that is still intact. And I'm going to explain that in a second after I go over the TLT chart. The reference low that was key was this 115.26, and today we closed at 115.23, so slightly below there, which is bearish. We did form a bit of a hammer. It is a bit of a look below, sort of. I wouldn't say it was a look below and fail, because we did close below that that reference low. So it's sort of, I guess, a look below and accept, but accept sort of. It wouldn't shock me if there is some type of a Greek default that this will obviously, the TLT will have some legs into it. I've said, though, that I think that the downside, believe it or not, from here is rather limited. 113.37, and I'm going to show this in the weekend video, is the 1.618 Fibonacci extension on the leg. So I believe that that area will catch it. This area here, the measured move was roughly into the 117s, and I've said for a while that 117 is the fulcrum pivot for TLT. Above 117 is bullish, below it is more bearish. We're below it right now, so it's a little bit more bearish. That is a bit of a chink in the armor with the rates for lower thesis. But I think what people are missing with the lower for longer is that the Fed has already said that they're not going to raise interest rates to the typical amount. Usually they hike and hike, like Greenspan did, and Bernanke actually toward the beginning of his career. And they take interest rates up to about 6%, and that's what causes the crashes in the market, because I guess the discount rate that you discount cash flows is so high, the hurdle rate, so to speak, and also the bond competition. Wealthy people, if they could put their money in for 6%, what are they messing around in the stock market for? So That's what I'm thinking. The trajectory, sort of the thing that people on TV and the intelligentsia on Twitter, dripping in sarcasm here, they always miss is the rate of change. That's sort of your convexity, if you will, with regard to bonds. Or if you're looking at stocks and you're an options wonk, that's your gamma. It's sort of the gamma risk, the rate of the rate of change of the delta. That is really what matters. And I don't believe the volatility on rate. I think they're going to cap out at 3.5%. I don't think the Fed is going to want to raise above there. It's just sort of I don't really have a exact point to hang my hat on with that. Like, they haven't come out and published that, although I think that would do wonders for the market if the Fed came out and said the path to normalization, caps out at, let's say, 3.5%. That, I think, would be a healthy level for them to raise to, and the market would probably respond fairly well. That may have an initial, hiccup based on that, and I think that there is risk of an initial hiccup based on the initial increase in terms of when they raise rates, although I don't necessarily believe that's going to happen this year. That's going to depend a little bit on the TLT behavior here. I'm starting to think that maybe they're going to try for the one and done for this year, but I don't see the data that does that. I mean, the GDP was negative the first quarter. Yeah, it was a little less negative than they thought, but the labor participation rate is junk. It's the lowest it's been in 36 years. Since 1978, I believe, that was the lowest rate. And there's a lot of uncertainty, obviously, with Europe and this Greek default. Speaking of which, the Greeks are now saying that they want a haircut from Germany on the amount of debt due, and they're calling it the amount of money that they borrowed. They don't want to pay it all back, and they're basically saying they're being blackmailed. You want to retire at 55 and you want to borrow tons of money and then not pay it back. Just try that with your credit card. See what they tell you. Charge up a bunch of vacation days on American Express or Visa, and then call them up and tell them it's blackmail and see how they respond to you. So I think the Germans are not really going to be on board with these cuts unless they see some type of concessions. I am still of the mind that there's going to be a last-minute can kick. It might even be a little bit lower than you think. So I believe that that the can will be kicked. It's probably going to be it might be an overtime for all, we just got through the Stanley Cup a couple weeks ago. We might be in an overtime win situation here. So I'm thinking that that's going to be the case. Why, someone just asked me why, exactly, the wimpy, give me 10 today and I'll give you 5 tomorrow. Yeah, exactly. That's what the Greeks are trying, and I don't think that's going over well. So why would Greece be a risk? I think in 2011 the risk was greater because there was more of a risk of contagion into the periphery, i.e. Ireland, Italy, Spain, and Portugal. But I think a lot of that sort of contagion risk is maybe more contained than it was back then, because a lot of the debt is owned by governments at this point. And it's not held in, you're not going to have a Lehman situation per se. That's always what everyone's afraid of, that you're going to have who owns what and when did they own it and what size are they in. There's always the fear of the other guy, who's going to blow up. And I believe that's really the fear with this, is the contagion risk. You also have something a little bit different now than we've had in the past. In 2011, when the last major correction had taken place, there wasn't European QE happening. Draghi has sort of made it known that it's by any means necessary, and I believe that they will step in major size, probably along with the Fed, believe it or not. You're not going to be hearing, what you're going to start hearing, this is tomorrow's newspaper for you. If there's a Greek default, you're going to start hearing the Fed talking about reopening the swap lines with Europe. And that's going to allow a lot of liquidity into the market and I think dampen some of the sort of contagion fear, at least short term. I don't believe that there is going to be the default, but if it happens, I think they will default eventually. I just don't think that this is sort of the time yet. So that's my thinking. But keep your ears open for the Fed talking about reopening swap lines with Europe. And I think they're going to try and mitigate the implication on the euro, because if Greece leaves, theoretically, that makes the European Union a bit stronger, right? Their currency should be stronger. So the fear, I guess, there is the spike in the euro. So I believe the big question then becomes is how high can the euro go? If you take a look at the chart of the euro, believe it or not, it is starting to look a little bit like an inverse head and shoulders, although it's looking kind of like a, I don't know, it's got like a double head and a double right shoulder. I've said for a while, when everyone was talking about parity with the dollar, I've been saying that I thought that there was a potential to retest the breakdown level that the euro came from. And I think that there could be room, believe it or not, somewhere between 120 and the real breakdown level where this kind of really got going, which was like the mid 122s. Yeah, there could be a little bit more of an overshoot, but I think that would hold it back. That's a big move from where we are now. I believe we closed today. I'm just looking at the Euro USD chart. It held the 50-day moving average and it closed at 116. So this could be telegraphing a rise in the euro. So we're going to have to see how this plays out. If that does happen, there'll probably be an initial pullback on Greece. Again, the levels are what is key, not necessarily the sentiment. And what I always do if people are getting really wacky about where things could go, I look at what's being priced. And all you need to do to alleviate some of your fears is go into the platform, take a look at the options chain, and just look at the number that's being priced in. People are always talking about, oh, the market's going to tank and this and that. Yeah, for next week, with the next 4 days, the expected move in SPY is being priced in at $3.66. So that's what you're talking about. A plus, I would say that the IV level, the VIX here is a little bit on the, actually we're a little bit more mid-range here. We did have a bit of a rise in volatility, so around 14. The ceiling of the recent move has been 17. So we're sort of a little bit there. We had gotten to, if you take a look at the VIX, let's just talk about that quickly. It failed again, and I'm going to show this in detail in the weekend video. Don't worry if you're not, if you're not in front of a chart or you don't know what I'm talking about. It's still below the 200-day moving average, which is really key for the VIX. That's been resistance. Anything above there has been unsustainable. That level right now is 1531, so there is potential for slightly higher there before you have to get really nervous. I don't really see volatility shifting into an upward pattern unless it can take out 1720 to... There is a couple of levels in the 17s that are always important for me. 1720 is the first one because that was the double top where volatility kind of sank from. There's 1757 and 1785. If the VIX can sustain over those levels, I believe you're going to see the upper levels again in the 20s. I would think that the first shot there would be to like 22, 23. I've said for a while that anything above 20 is, elevated volatility. Anything between 20 and like 25 is kind of fear. If anything ever gets over 25, you're in crash danger zone. So always keep that in mind. If volatility breaks out, I would say if you get over 25, 20 at this point, there could be something much more dangerous lurking out in the market that we don't necessarily know. Again, we're well below there at the moment, so there's nothing sort of yet to fear in that instance. But every time, the VIX sort of has its natural resting place. You start getting down close to like 10-ish. We got down to like 1193 this last go, which, by the way, is a slightly higher high than the last one of 1182. So that to me is showing that the VIX is just having some response. When options get a little too cheap to sell, people buy them, and when you're buying options, that's what raises the volatility index. It could happen, believe it, mostly we're known for it on the put side when people are reaching for puts, protection. But believe it or not, if there's a blow-off top in the market, it could spike also based on a reach for calls. And I've been saying that options are cheap. They're too cheap to sell, so they're just right to buy. Speaking of which, the last few weeks, I really haven't been doing that much in the market. I've been a little bit more quiet on the stream. I've actually had some other things I've been working on in my own personal life, and actually the subscription service that I have been discussing. There's been a little bit of progress on that. So with regard to the market, though, I've been just saying this is that play smaller size, smaller time frame, and look for a smaller swing. Sort of the aim small, miss small. There's been a lot of sort of false breakouts or false breakdowns, and a lot of kind of not so much follow through in the market. So just be a little bit careful. If you're normally looking for 10 points and you get, let's say, like 3 or 5 in a day, book some profits. No harm in that. One stock which did defy the markets this week was Facebook. And that is one that I have been talking about going to 100. Now it seems like everyone thinks that, which makes me a little bit more cautious. Although once in a while, people are right. I would be a little bit cautious, though, if you're first initiating on Facebook now, although today's price action was fairly bullish. The typical Facebook pullback is usually about $8 or more off the peak, and we peaked at 89.40. If you look back to what has been some resistance and like the breakout level here of Facebook, it was between like 82s and 83s. So that would roughly take us back to a retest of that breakout. I don't know if this time is different per se, if we're going to really get the acceleration we want. Some of the things I've been talking about when everyone hated Facebook down in 78s was the accelerated revenue growth, which now seems to be consensus, the fact that they're taking share from Google, which is now consensus, and also the fact that they're going to be monetizing Instagram. And I believe some of Twitter's woes have been because of Instagram. It's sort of that simpler platform with photos. I was messaging the other day. I messaged some of the bigwigs over at Twitter on Twitter. They didn't respond to me, but I said that they really should be trying to become more Instagram-like as opposed to Facebook-like. Yes, someone just messaged that they're having trouble with connections. I will be rebroadcasting this as always on my YouTube stream. That is at it's Justin Pulitzer Trades. If you're following me on Twitter, it's in my profile. You can see there's a link to my YouTube channel there. If you're not following me on Twitter, my handle is at Justin Pulitzer, so be sure to follow me. I do a lot of weekend videos. I do a lot of trades live, or give trade setups that I'm seeing or thinking. It's a good thing to do. Speaking of Twitter, the stock here seems to be kind of muddling around and just chopping and gaining a little bit of traction. You have, I think, what should be, quote unquote, a secure low in at 33.51. The reason it would be secure is it's a lower low with excess that is bookended by two higher lows. So, and then today's low held above the last sort of old dump low of 34.62. So if you get back below 34.62, you might want to be a little bit more cautious. I think that the deal with Twitter is it's just going to be a lot of chop until the next earnings. I don't think a lot of it's really not that far from now. The earnings are on the 29th, 7/29, so in about a little over a month. And I believe that the stock is just going to be choppy and sort of dead money from there. If there are rallies in it, I don't necessarily know that it's going to be the turning of the stock. I do believe, and I've said this before, at some point we're going to get up to roughly close to $45 a share. At some point, I don't know if it's going to be on takeout rumors or if it's going to be maybe they actually don't muff the quarter here for, once, that would be nice. Or if they have, a good new CEO, there'll be some type of news. It's just not going to happen on its own accord, I don't believe. Yeah, their model is not good. I think that they need to make their service a lot more user-friendly. Like, I talk to some of my friends who are on Twitter. They don't really use it. They don't really understand it. They just say, why don't I just use Facebook or Instagram? Snapchat seems to be getting popular. I also believe when that comes public, that is going to make Mark Zuckerberg look like an absolute genius, that he only paid $1 billion for Instagram. The valuation on Instagram will be quantified more, and that will be huge. Speaking of tech companies that just came public, there's Fitbit. I don't really believe in their product. I think that they're going to get slammed longer term by companies like Apple, but that doesn't mean that the stock short term can't go higher. The thing that I would be a little bit careful with today, we did fill the gap. You really need to see the stock above the. I'm just looking at the chart here. One thing I don't like are these young charts. They tend to have the run up, then the big pullback, and then they run again, or they pull back. There's just not a lot to really. There's no trends to be drawn. There's no moving averages. It's hard to sort of draw Fibonacci retracements, so to speak, on a couple of days worth of trade. There's really not that much there. You can't really short a lot of these instruments. There's sometimes not options on them. I try to stay away from these types of stocks. I know that people will pile in, though, when they can, but they will pile in short, and I think that will wind up being they'll be right for a couple of days, and then they'll be wrong because they'll get squeezed. The key level for me, and I would say if you're not in it, today it bounced perfectly, almost to the tick. I think it was 3 cents below, off the 61.8 Fibonacci retracement from the earnings gap, the earnings day low of day to the high of day earlier this week. So if you want to trade against something, I would say you might want to even trade against that. If you want to give it a little bit more room, 32.50 was the sort of the close before the gap. So in this area, roughly in these few points, you could, I guess if you want it, play right or right out. It's really not one. I may do it. I mean, it's as valid of a setup as any. But I'm not I don't really know enough about their company or believe in it. I don't use a Fitbit, so I don't even have the Apple Watch yet. I'm waiting for the second gen. FYI, if anyone's curious. I'm just looking through. Let's talk about. Let's see. Let's talk about China quickly. I want to get that off my plate, and we could cover BABA and all that stuff. So China has run up huge. The stock market has been up ginormous. And I believe that this is just a pullback, a correction. You're up 50% and you pull back 20%. That's sort of how it goes. There's been a lot of people opening up Chinese brokerage accounts. The public out there, the public is really involved in the Chinese stock market. They are not to the same degree involved in the United States. I take a cab, I go get my hair cut, I go to my dentist. No one wants to talk to me about stocks. No one cares. It's all us people on Twitter and fund managers, quote-unquote professionals, and I guess the step up from professionals, the semi-professional. But people really, for the most part, aren't that interested in the market. Once that happens, like it did in China, there you go. You got a stock bubble and a blow up. I think guys like Carl Icahn did a good job of scaring people this week with that. He said this a few times. It's sort of like the Babson comments before 1929. People are afraid that he's going to come out and mark the top. What a lot of people don't know is that Babson, for a couple of years pre-1929, had been saying the same thing. And eventually, if you say the sky is falling every day, you do it over long enough time, maybe it'll fall one day. That's sort of the thesis on that. Alibaba, speaking of which, is an absolute piece of insert expletive. They had really gone low. They had taken out their lows. It was sort of the fake out before the shakeout, as I had thought. It got up to about 95. I was looking for it to get to the 98s or to 100, but it sold off, and it's just kind of been making lower lows and lower highs. Anything below 84.91 and it closed below there is a little bit iffy. I would say it's getting a little bit oversold short term, and there might be a bounce in China. I think they were down something like 17 or 18% in the last few days, and that's a pretty big move. The close before the earnings gap was $80. So I sort of see $80 as sort of the downside risk in BABA. There was a lot of put interest and call interest with regard to BABA at 85. I was a little bit surprised, I have to confess, that it broke the 85 today and was able to close below there. It was 83.23. So, yeah, I mean, the stock is just weak. I would wait for the pattern to start shifting. Instead of seeing lower lows and lower highs, wait to start seeing higher highs and higher lows. Being the first is sort of the not always the best. But I do believe there will be a trade if it gets to 80 bucks. That would be a good right or right out type of a play for me. I would also be interested in it for a day trade if today was sort of a look below and fail false breakdown, and we took out today's high like on Monday. If it could happen in a gap and go situation, I think would catch a lot of people off sides. There probably were a lot of people pressing their shorts today. So anything above 84.65 to maybe 85, if it can get it back above there, then I think there's probably room to the upside there. But really, just a junky chart. I mean, really, this is about as bad as they come. Let's take a look. Airlines. I've said it before. I'll say it again. There's only one airline stock that I like, the one that doesn't have a broken chart, and it's not Delta, it's not American Airlines, it's not. I said Delta, American Airlines. It's not Southwest, but it's JetBlue. I am long JetBlue. I am long with a. How am I long? Let's take a look. 21.25 call spread with 84 days to expiration. I'm up a little bit on it. Nothing major. It wasn't really a very expensive play to put on. What I do like about JetBlue is that it's above its downtrend line. It's also above the last swing high before the. It's starting to make higher highs off of. It made a lower low, but it's starting to make higher highs on the swing. So if you're going to play in the airlines, the only chart to me that doesn't look busted is JetBlue. That's the only chart I think that's okay. The other way to do it is this new ETF, this JETS, which is, believe it or not, starting to look like an inverse head and shoulders here. I would be a little bit wary with that if it starts getting below 22.56, so let's say like 22 half-ish. If it starts getting below there, it's starting to be a bit much. If you can have a neckline breakout there of 23.63 to 23.74 in that area, then I think you're probably going to go a bit higher, and you might see some reversals in the airline pattern. Speaking of Mr. Icon before, I didn't follow through on that, but let's talk about Netflix a little bit. So my thinking with Netflix is that it was to sell the news. The stock gapped up 20 bucks on news everyone knew was coming. You got to be real smart money, right, to be first piling in at Netflix at 700 plus on a gap of $20 or more. So Icon did, the smart thing. He sold into strength. I mean, the guy made like $2 billion, I think, on the stock. So I guess better than a sharp stick in the eye, so to speak. The question is how does the stock behave? It has some earnings coming up. It's got it's kind of just resting on the 20-day moving average. It's down a lot over the last few days. I've said for a while that I thought it was going to pull back into the earnings range. But I looked back into history a little bit about how Netflix has behaved. And the answer was this, is that the last time Icon tweeted, his high, I believe, was 389.16. And after that tweet, Netflix pulled back 80 bucks. So I'm sort of using that as the model. And if you use that as the model, the pullback level would be about 626. So the 50-day moving average is 612.04, and I think somewhere between 612.04 and 626. I realize it's a bit of a wide range, but it is the the stock got to 700 bucks. It's not all that crazy. I think in there it'll find that 50-day moving average is an absolute day trade right or right out buy. I think you could at least catch $5 to $7 off that. I will be in there trying it. If it does do what I think it's going to do and pull back, it'll probably get somewhere between 568 and 530, somewhere in that earnings gap range. I think I'm going to discuss a little bit more on this one with a Fibonacci retracement level. I don't have a new one drawn in just because the stock had moved so much. There was no real reason to have fibs drawn in, but I believe that the stock. Yeah, here, I just put it in here quickly. I have to adjust the lows and that, but you're talking roughly around, like, this thing has moved so far, 489 would be a 50% Fibonacci retracement. That's absolutely incredible. And the 61.8 is 472.67, which was basically where the gap was from the last earnings. So I would be a really motivated buyer there if we ever got down there. I'm not necessarily sure it will. Netflix tends to have these crazy earnings gaps sometimes, like $100 or so. If we got one of those, I'd probably be, since we're coming from an all-time high, and I think a lot of people feel like they missed this, I would be an interested put seller on like day 3 of a gap down like that. I think that would be that would work out really well. Maybe if it's if they report late in the week, like if they report on like a Thursday, or a Wednesday, I'd be interested in selling out of the money puts that expire that Friday on like a gap down like that. So I think the stock is going to hold up into the split, frankly. I think you'll probably find some traction and it'll start catching itself. I just don't know that we're going to make a higher high, so to speak, on the on this leg with the stock. Tesla. I've been bullish on the stock for a while here. I said I thought we would get back to 265. Anything above now, 265, to me puts the old all-time high in play, which is 291.42. So I think that will be in the cards at some point. There is also a Fibonacci extension to start looking at there. The 1.272 is 321.35, and the 1.618 is 359.41. So Tesla's got a lot of news coming out. They have the Model X. It's always been a short squeeze stock to me. The story with Tesla has never really been so much about the fundamentals of the company. It's been about the mechanics of the stock market and the stock. High consolidated inside ownership, poorly distributed stock as a result of that, and a high short interest. Those things lead to higher stock prices. And seasonally, this is very good for Tesla. They peaked out at the end of the summer last year, so maybe we have a summer run. Anyhow, I think I've monopolized enough of the time today, and it's Friday and it's 5:30 and it's time to go, right? I mean, it's been a long week. So let's break there, and please be sure to follow me, like I said, on Twitter at Justin Pulitzer, and also be sure to check out my YouTube channel. Anyhow, let's have a good week, and I'll see you guys on Sunday. Cheers.